In this video, we're breaking down what happened to TD Ameritrade.
The best retail trading platform ever built for the active investor. The options analytics were institutional grade. The scripting language let ordinary traders write custom studies. The programming interface powered thousands of automated strategies. The education library was unmatched. Then the largest retail broker paid $26 billion for it and spent 4 years absorbing it into a larger machine. Custom scripts stopped transferring. Alerts stopped firing. One trader's account showed 60,000 less than it should have, and the support ticket sat open for 13 months before the broker closed it without fixing it. Another trader's phantom margin call blocked all withdrawals for 2.5 years. The programming interface was shut down permanently, and the cash sweep rate on uninvested cash landed at less than 0.5%, while competitors pay over 4.5%. This is what happened to the platform that changed retail trading. The founder was born in 1941 in a small city in Nebraska. His father ran a small business. He worked as a broker at a traditional full-service firm in the early 1970s and saw what he suspected confirmed. Retail investors were being systematically overcharged for a service that technology could deliver far more cheaply. In 1975, he founded a discount brokerage with approximately $12,500 in startup capital, partly borrowed from an uncle. The concept was radical for the time. Execution only, no advice, a fraction of the price. He was doing from a small office in Nebraska what a competing firm was simultaneously pioneering on the West Coast. The company was renamed 3 times across 2 decades as it grew. In the mid-90s, it became one of the first retail brokers to offer online trading. The $8 flat rate trade changed the industry when competitors were charging $65 or more. In 2006, a Canadian banking group acquired a 39% stake for approximately $2.9 billion. TD Ameritrade now had the backing of one of the largest financial institutions in North America. In January 2009, it paid $606 million for the options platform that would define its identity for the next 15 years. That acquisition brought institutional-grade options analytics, a scripting language, probability analysis, and a platform culture that attracted serious traders who would never have considered the original retail interface. A further acquisition in 2017 for approximately $4 billion doubled the client base to roughly 12 million accounts. TD Ameritrade was now the second largest retail broker in America, with the best active trading platform in the industry. In 2019, leaked emails from the founder's private accounts surfaced, containing racist jokes, anti-Muslim content, and claims questioning the citizenship of a former president. He apologized. There were no legal consequences. On the 1st of October 2019, a competitor announced zero commission trading. The next day, the largest retail broker matched it. The day after that, TD Ameritrade, the remaining competitors, and the largest fund manager all followed within hours. The entire retail commission model collapsed in 72 hours. 6 weeks later, the largest retail broker announced it was buying TD Ameritrade for $26 billion. The acquisition logic was consolidation in a suddenly lower margin business. The buyer wanted the options platform it had never built, the 12 million client accounts, and the cost savings from merging 2 large operations. During the meme stock event of January 2021, the platform raised margin requirements on volatile stocks but did not halt cash purchases the way a smaller competitor did. That distinction spared it from the worst of the congressional backlash. The migration began in September 2023. The accounts moved. The problems arrived with them. One account showed a net liquidation value of $41,000 when it should have shown $101,000. 60,000 missing. 600 shares of a major technology stock completely ignored in the transfer. Wash sale rules applied incorrectly. 13 months of escalations. The ticket was closed by the broker without resolution. Another account displayed a phantom margin call between 10 and 30,000 despite having positive buying power. The system showed 0 available for withdrawal. The trader reported the issue had persisted for 2.5 years. The margin team was still investigating. Custom scripts that traders had spent years building did not auto-transfer. Alerts that active traders relied on for position management stopped firing. A pricing error on a position forced a closure at a loss of $7,400. The programming interface that powered thousands of automated strategies was shut down on the 10th of May 2024. Every system built on it stopped working. The replacement required rewriting the authentication, the endpoints, and the data structures from scratch. The cash sweep is the ongoing cost. Uninvested cash sits in a bank deposit account, paying less than 0.5%. A standard money market fund in the same period pays over 4.5%. A competitor pays 4.58%. On 100,000 in uninvested cash, that is the difference between earning 450 a year and earning 4,500. The securities regulator had already fined the acquiring broker 187 million for the same practice in its automated portfolio product. The model remains unchanged. The original platform's cash sweep rate was roughly 0.33%. The new rate is marginally higher. Both are approximately 10 times below money market alternatives. The financial industry regulator fined the company 550,000 in September 2025 for failing to properly report millions of trades, including fractional share transactions that were never submitted to the required reporting systems. The firm self-reported the issue, which reduced the penalty. The conduct predated the full integration. The acquiring broker inherited and resolved it. The community verdict from active traders in 2025 and 2026 is consistent. The platform still works. It is still the most capable retail options environment available. The scripting language is unmatched outside of one competitor. The paper trading simulation is among the most realistic. But the performance has degraded from what it was. Execution quality is described as worse. The interface has stagnated. The traders who built their workflows around the original version consider the current version a step backwards. The ones who left went to the options platform built by the same person who created the original, to the broker with the best programming interface, to the algorithmic platform with the competing scripting language, and to the free charting platform that serves as a lighter alternative. Anyone who needs the most capable retail options, analytics available, where the scripting language, the probability tools, and the paper trading simulation still outperform every competitor except the algorithmic platform's scripting environment, where the acquisition preserved a platform that could have been shut down and where the education library remains the deepest in the industry. Accepting that the migration created account errors, including a 60,000 discrepancy, open for 13 months, and a phantom margin call blocking withdrawals for 2.5 years. That the programming interface was shut down, forcing thousands of automated traders to rebuild from scratch. That the cash sweep pays less than 0.5%, while competitors pay over 4.5%. That the securities regulator already fined the acquiring broker 187 million for the same cash practice. And that the community consensus among the traders who built their careers on this platform is that it is worse than what it replaced. The best retail trading platform ever built still exists. Whether it is still the best is the question the migration answered. Every choice is a trade-off. At least now you know what you're trading.